We are going to be looking at business combination. Business combination. IFRS 3. Business combination. IFRS 3. So, which is going to lead us to preparation of consolidated financial statements. So, which is going to lead us to preparation of a consolidated financial statement, which is known as group account. So, but before we start saying we are preparing a consolidated financial statement, what are those things that we really need to understand? What are those things, those concepts, those foundations that must be laid for us to start the preparation of a consolidated financial statement? So, the business combination is the basics. Okay, so you can see my screen, right, Mail?
Yes.
All right. So let's start. So when we talk about business combination, let me match this business combination. That's IFRS 3. So the topic is actually broken down into different segments: business combination, IFRS 3, and together with it, we are going to be looking at IFRS 10, which talks about a consolidated financial statement, and we are going to be looking at IAS 27, which talks about a separate financial statement. So that's the concept of everything. So, there is a role of IAS 27, there's a role of IFRS 10, there's a role of IFRS 3, but the overall concept of everything starts from business combination. So let's start. When we talk about business combination, first of all, a business combination talks about business combination, that's IFRS 3, talks about the acquisition of one entity by another entity. IFRS 3, business combination, talks about the acquisition of one entity by another entity. So when an entity is buying another entity, that's a business combination. Are we on the same page?
Yes.
Let's look at it from this angle now. So let's say company A. Now, company A acquires, let's say, Let me use this. Company A acquires, let's say, 10% interest in company B. Now, this is company A, the acquired entity, the investing entity, the investing entity, the entity that is acquiring interest in another entity. Now, company A is acquiring a 10% interest in company B. Now, you should understand that this 10% interest that company A is acquiring in company B cannot bring about business combination. It cannot bring about business combination. We call this an equity interest. Equity interest. So an equity interest exists when the percentage that the acquiring entity is buying from the acquired entity is between 1% to what? 19.9%. Let's take note of that. Equity interest.
Please repeat that part.
Yeah, equity interest will exist. Equity interest, or you call it simple interest. If you don't call it equity interest, you can call it simple interest. So equity interest will exist where the interest of the acquiring entity is between 1% to 19.9%. Now, when the interest is between 1% to 19.9%, you must understand that there is no business combination. We only have interest in the company. So if the company has, like, when we say we are buying the interest, we are buying a percentage of the company's shares. So if a company has 100% shares and the percentage we have in that 100% shares, the percentage we have is just 10%. So that 10% cannot lead to a business combination. We just want somewhere to put our money in. Now, this kind of investment is guided by IFRS 9. So IFRS 9, which is what's this IFRS 9? What does this IFRS 9 talks about?
Financial instruments.
Financial instruments. So it is IFRS 9 that talks about this equity interest. So let's take note of that. Company A buys 10% interest in company B. So the kind of interest that company A has in company B is equity interest. Now, let's come here again. The same company A acquires, now this time around, let's say acquires, let's say 25% interest in company B. So if you look at this now, company A in this second scenario, so let me call this scenario 1. Scenario 1. Let me call this scenario 2. Now, in this second scenario, company A, the acquiring entity, which is the investing entity, has 25% interest in company B. So that means out of the 100% shares of company B, I am buying 25%. So this 25% interest will fall under the interest range, which is between 20% to 50%. Now, what do we call this? We call this a significant influence. A significant influence. Now, no business combination. So the concept here is that for scenario 1, no business combination. For scenario 2 as well, the same thing, no business combination. Now, why is there no business combination in scenario 2? Because we are buying 25%. So 25% falls within the range of 20% to 50%. The first scenario, we are buying 10%. 10% falls between the range of 1% to 19.9%. So 25% is a significant influence. Now, when we say a company has a significant influence, so what it means is that there is no business combination. There is no business combination, but we have influence over that company, but we don't have control over the company. Let me take that again. We have influence. Now, the influence we have over that company is a significant one, but we don't have control over the company. There is no control over the company at all. So we can't call that a business combination. So the extent of the influence is such that when they want to make decision, we will be there. When they want to make decision, we will be there. We'll be at the board meeting. We'll be there at the board of directors meeting when they want to make decision. But our decision does not count. I don't know if we are getting it.
Yeah.
Now, the decision of company A, if company A is buying company B, automatically all the directors of the investing entity will have this kind of significant influence over that of company B. So we are saying that in the meeting, our directors will be there. Yes, be there, will be present, but there is no business combination. So no business combination means that what we don't have that level. We have not attained that level where that company we are buying can be subjected to our own power. So it's just a significant influence. So a significant influence gives us or puts us in a pole position, but it does not bring about a business combination. Do we understand that part?
Yeah.
So that's the concept of significant influence. So let's take note of that. So now scenario 3. Now, scenario 3. Now, in scenario 3, company A, same company A acquires, still using the same scenario, company B. Now, company A acquires 50% guaranteed interest in company B. 50% interest guaranteed in company B. Now, what do we call this? We call this joint venture. Joint venture. Are we on the same page?
No. Just
yes.
Yeah, sorry. The one with significant influence. Is it up to 50% or 49.9?
Okay, let's call it 49.9 then. Let's call it 49.9%.
Okay.
Let's call it 49.9. Now, these ones, they are called associates.
Okay. Another name, Abi. Okay.
Yes. So any company that has a significant influence over the other company is an associate. Exactly, is an associate. And this associate is accounted for in line with IAS 28. Is accounted for in line with IAS 28. Even the joint venture too is accounted for in line with IAS 28, joint venture and associate. So that's the significant influences associates. Now, joint venture is 50% guaranteed. So the difference between joint venture and associate is that Even in joint venture too, there is no business combination, but we have 50% of the interest. So it's a joint venture. It's a venture. So the key thing in these three guys. Okay, let me note it here. No business combination. No business combination. Now, the key thing that I want us to note here within these three guys is the fact that in these three scenarios we have created here is just one factor, and the factor is what? Absence of control. Absence of control. So it means that these three guys is lacking something. What are they lacking?
Control.
So because they are lacking control, we can't say they have what? A controlling interest in that company. Do we understand? So that's what I said. In the first scenario, there is no business combination. In the second scenario, there is no business combination, but just a significant influence. In the third scenario, there is no business combination. Now, the reason why there is no business combination from this three scenario is very simple, and the reason is because there is absence of what? Control. So none of these investing entities has control over the other. None of them has control over the other. So company A does not have control over company B in the first scenario. Company A does not have control over company B in the second scenario. Company A does not have control over company B in the third scenario. So let's now look at the next scenario. Scenario 4. So by scenario 4, company A, the investing entity, now acquires let's say 60% interest in company B. Acquires 60% interest in company B. Now, if you look at this last scenario, this kind of interest is called a controlling interest. So a controlling interest will exist when the range of percentage of interest the investing entity is acquiring over the entity that is being invested upon is between what? 51% to what? 100%. So if I have interest that is between 51% to 100%, that kind of interest is known as the controlling interest. And controlling interest will lead to a business combination. So in scenario 4, there is a business combination. Why is there a business combination? Because there is a controlling interest. So any time there is lack of control in any investment, it does not lead to a business combination. But anytime the interest we are having or we are acquiring in the acquired entity is over 50%, then there's a controlling interest. So in scenario 4, we can say company A has what? Control.
Controlling interest.
Control over company B. So in this scenario, company B is subjected to company A's authority. In the first scenario, company B is not subjected to company A's authority. In the second scenario, company B is not subjected to company A's authority. In the third scenario, company B is not subjected to company A's authority. But in the last scenario, company B is subjected to company A's authority. Why? Because there is a business combination. And a business combination will bring about what we call a parent company, and a subsidiary. Business combination will always bring about a parent company and a subsidiary, which we call as one. We call them as a what? Group. Call it a group. So a controlling interest is only the interest that brings about a group. So when we talk about a group, before you can say a company is a group, first of all, check, is there a controlling interest? How do you ascertain that there is a controlling interest? When the interest that the investing entity has in the invested entity is over 50%, then we can say there is a controlling what? Interest. Then we can call that company a what? Group. Then we can say a business combination does what? Exist. Do we understand?
Yeah.
So, in a nutshell, a business combination is the process which one entity acquires another entity. Is the process which one entity acquires another entity. So, for business combination to exist, the key factor there is that what? There must be a controlling what? Interest. So, what are the elements of control? Element of control. So how do I know control exists? Number one element of control is that the parent company has power over the subsidiary. That's number one element of control. The parent company has power over the subsidiary. Number two element of control is that the parent company has right to variable returns. As a result of his investments. Has right to variable returns as a result of its investment. Number three element of control is that the parent company has the ability to influence the subsidiary's return. So, these are the elements of control. When these three things, okay, let me add one more. One more element of control is that what? The interests must be over what? 50%. So these are elements of control. So how do I ascertain that a company is a group? How do I ascertain that an investing entity has control over the invested entity? Number one, the parent company has power over the subsidiary. The parent company has power over the subsidiary. Number two, the parent company has right to variable returns. Now, what gives me the right to variable returns? Because I have investments in that company. And the investment I have in that company is as a result of the fact that what? I have a controlling what? Interest. Number three is that the parent company has the ability to influence the subsidiaries' what? Return. The parent company has the ability to influence the subsidiaries' return. Then number four is that the control must be over 50%. So let's take it from there. So we will now talk about, remember we said it will lead to a group. So group. We'll talk about group. So we'll talk about a group. What do we understand by a group? So I can say a group of company is a company where an entity known as the investing entity or the parent company acquires a controlling interest in the acquiree, that is the invested entity, which is also known as the who? Subsidiary. So a group of company brings about a what? A parent and a what? Subsidiary. So when we are talking about a group of company, we must talk about a parent company and a what? Subsidiary. So what is a parent company? Or who is a parent company? So a parent company is the company that has control or that has investments over 50% in the subsidiary. Then who is a subsidiary? This is a subsidiary. A subsidiary is the company that is controlled by the parent company. The subsidiary is the company that is controlled by the parent company. Are we on the same page? Are we on the same page?
Yes.
Okay. So, the rule of business combination is that when a parent company, so according to IFRS 3 business combination, it says that what the parent company must prepare two financial statements. The parent company must prepare two financial statements according to IFRS 3 business combination. The parent company must prepare two financial statements. The first financial statement is a separate financial statement in line with IAS 27. Then the second financial statement is a consolidated financial statement in line with what? IFRS what? 10. So that's the concept. Now we have established that what? There's a group of companies. Abi, a group of company is as a result of business combination. Yes. Now we have now
Your
said
background is echoing.
my background.
Yeah. Maybe it's network.
I'll just tell them to. So we have established that there is a business combination, and we have established that what a business combination will lead to having a parent company and a
Sorry,
subsidiary.
are you using earpiece? Are you using
Yes,
earpiece?
yes.
Maybe you need to check the earpiece. It's not clear.
Um, can you hear me now?
Yeah, but it's like there's a form of like echo. So it's not, your speech is not clear. It's like the earpiece is shaking or something.
What about now?
Okay, it's better now. It's better
Oh,
now. Thank you.
okay. So that's what we are saying. So we are now saying that what, since there is now a parent company and a subsidiary, so how do we account for them? So the overall concept of what we are doing or what we are learning or what we want to start learning is what, how do we account for a group? But before we start getting to a concept of a group, we need to understand what brings about a what group. So we have understood that a group was given birth to as a result of a business combination. So a business combination is the only thing that gives birth to a group. And we now know that what a group is made up of a parent and a subsidiary because of the controlling interest that the parent company has over the subsidiary. So we are now saying what is the provision of the standard, that's IFRS 3, on the business combination. So IFRS 3 is now telling us that what, anytime a business combination exists, the parent company must prepare two financial statements. That's the rule according to IFRS 3. And what are those financial statements? Number one financial statement is a separate financial statement according to IAS 27. And number two financial statement is the consolidated financial statement. So that consolidated financial statement is our own area of focus now. So what we want to learn how to do going forward is, how do we consolidate a financial statement? So, but before we start talking about consolidated financial statement, let's
You're
try
echoing
to,
it again.
okay, before we start talking about a consolidated financial statement, let's try to
I can't hear you.
understand. Eh? Is it clear now?
I can't hear you. No, no.
Can you hear me now? Eh?
Hello?
Can you hear me?
Okay, it's better now. It's okay now. It's clear now.
What about now? What about now?
It's okay now. It's okay now. It's okay now.
Okay, so I can continue
I
like this
think it's
now,
your
right?
earpiece. Yes, I can hear you clearly now.
Okay, okay. So, so before we start talking about a consolidated financial statement, let's now look at what business combination now helps us to understand. So, I said that IFRS 3 business combination says that what, a parent company must prepare two financial statements. Now, the two financial statements is separate financial statements and the consolidated what, financial statement.
Financial
Now,
statement.
according to the separate financial statement, IS 27 made provision that when a parent company is preparing a separate financial statement, the parent company must prepare a separate financial statement, which is as a result of its investment in the subsidiary using any of the three methods. Any of the three methods. A is the cost method, the cost method. B is the equity method. Then C is the the fair value through profits or loss method. So these are the three methods that IAS 27 makes provision for.
Sorry, come again. You said when a company is preparing a separate financial statement, it must
Yes,
prepare it according to ISM. It must prepare it.
using these three methods. That's the
Okay.
cost method, the cost method,
You
the
said something like
equity.
investing.
I said, you know that the reason why we are preparing the separate financial statement is as a
Yes.
result of our investments in the subsidiary.
Oh
So,
yeah.
so IS 27 is now saying that what because we have invested in the subsidiary and we have to prepare a separate financial statement. So, a separate financial statement must be prepared in line with the following method according to IS 27. So, we can use either cost method, equity method, or fair value through profit or loss method. So those are the three methods that are available for preparing a separate financial statement. So what is a separate financial statement? Now, a separate financial statement is the financial statement of the parent company alone. Is the financial statement of the parent company alone. So it does not show a combination of both parent company and the subsidiary. So a separate financial statement is the financial statement of the parent company alone. So according to IAS 27, the parent company must prepare a separate what? Financial statement. Now, according to IFRS 3 business combination, according to IFRS 3 business combination, IFRS 3 says that what the controlling entity, which is known as the who, parent
Parent
company,
company.
should account for the business combination using acquisition method. Using acquisition method. So according to IFRS 3 business combination, how do we account for a business combination? So according to, let me just put the heading here, accounting for business combination. Accounting for business combination. So how do we account for business combination? So in accordance with the IFRS 3 business combination, the parent company, which is the controlling entity, must account for the business combination using acquisition method. Using acquisition method. So if we are to use acquisition method to account for the business combination, what are the steps? Now we are now getting to where we are going to. So what are the steps that acquisition method prescribe that we must follow? So steps of acquisition method. So number one step is that what? Number one, identify the acquirer. That's number one. Identify the acquirer. Number two, identify the acquiree. That's number two. Identify the acquiree. Now, number three, identify the date of acquisition. Now, when we are solving questions, these are the things we are going to be looking out for. So business combination has already helped us to highlight those steps that we must follow. So business combination is saying that what for you to be able to account for this business combination, to be able to prepare that consolidated financial statement, what are the steps we have to follow? So the first thing is that what we identify the acquirer. Who is the acquirer? The acquirer is the entity that is investing, right? That is
Yes, the parent
acquiring that
company.
controlling interest, that parent company. Then number two is identify the acquiring. So who is the parent company? who is the subsidiary. Number 3, identify the date of acquisition. The date of acquisition is the date at which the parent company acquires the
Invested.
controlling interest. No, take note, not invested. I can invest
Okay.
and not have control.
Okay.
What we are looking at here is the concept of control. So the date of acquisition is that date that the parent company acquires a controlling interest in the subsidiary.
Okay. Okay.
Yeah, that date that the parent company acquires controlling interest in the subsidiary. That's the date of acquisition. Then step number 4, after you have identified the date of acquisition, step number 4 now says that what? Identify identify the assets and liabilities at the date of acquisition. Identify the assets and liabilities at the date of acquisition. Are we together? Then
Yes.
number 5 now says measure the non.
The episode has started again.
Can you hear me now?
Okay. Yeah.
Okay. Is it better now?
Yes. Yes.
So step number 5 now says measure the non-controlling interest. So I'm coming to non-controlling interest. Let's read them. Now, step number 6 now says calculate or determine. Okay, let's use determine the goodwill on. Okay, goodwill or gain on bargain purchase on the dates of acquisition. So these are the 6 steps according to business combination. So we said that what business combination requires that what a parent company should account for the investment in the subsidiary using acquisition method. So according to the acquisition method, the first step is what? Identify the acquirer. The second step is what? Identify the acquirer. The third step is what? Identify the date of acquisition. The fourth step is what? Identify the assets and liabilities at the date of acquisition. So at the date we are acquiring the controlling interest, identify the assets and liability. Then number 5 is measure the non-controlling interest. Now let's quickly talk about non-controlling interest. So look at this group structure. Look at this group structure. Now, this is a group structure. So the group structure says Solar Limited. Then and we have let me say Solar Limited, and we have
Epic.
what about, is it better now? Okay, just hold on first. Can you hear now?
Yes. Better.
Just give me some minutes.
Okay. Yeah, better.
What about now?
Better.
Is it better now?
Yeah, better.
Yeah. Okay.
Yes,
So
it is.
this is a
Better. Can
group.
you hear me?
Yes, I can hear you. Are you hearing me?
Yeah, I can.
So this is a group structure. Kemisola Limited and Mayowa Limited. So Kemisola Limited acquires 100%. So let's now start understanding the whole concept of all this group structure. Let's see another one again. There's another one. Is another one. Is another one. Now, in the first group structure, let's make this one 60%. Let's make this one 75%. And let's make this one 80%. So, if you look at the first group structure, Kemisola Limited acquired Mayowa Limited. How many percent? 100%. So, this group structure is known as fully owned subsidiary. Fully owned subsidiary. So it means that what? Kemisola fully owns Mayowa because Kemisola is buying all the shares of Mayowa. So if Mayowa has 20 million shares, Kemisola is buying the whole 20 million shares. So we are saying that Kemisola has a full control. Full control. So take note of that. Full control. Full control. Now look at the next one. Kemisola acquired 60% controlling interest in Mayowa Limited. 60% controlling interest in Mayowa Limited. Now we call this kind of structure a partly owned subsidiary. A partly owned subsidiary. Why is it a partly owned subsidiary? Because out of the 100% shares of Mayowa Limited, Kemisola only has how many percent? 60%.
I'm not seeing that part of the screen. I'm only seeing the one of 100%.
What about now?
Okay. Yeah, I can.
Now, why is it partly owned? It is partly owned because Kemisola has only 60%. So I will call this a partly control or a partly control. Now,
Partly owned with control.
like partly owned subsidiary. This kind of group structure
control.
is a partly owned subsidiary. So the kind of control here is not a full control. It's a partly control. You get now? So now, if you now ask, where is the remaining 40%? Definitely, I am buying the remaining 40%, that's it, is not with Mayowa. The remaining 40% is acquired by another entity. But that other entity that acquired the 40%, they don't have control.
Oh.
You get now? They don't have control. So those kind of entity is the one we are calling what? Non-controlling interest, which is in short NCI. Do you get now?
Yeah.
So out of the total 100% of Mayowa Limited,
Kemisola is acquiring just 60%. So it means that what? The remaining 40%. So this one is 40%. So 40% is somewhere. 40% is not with Mayowa, because Mayowa definitely would have sold all his shares. So if I'm acquiring 60%, then there is somebody else, there's another company that has another percentage. But that company that has the remaining percentage does not have the control that I have. Why? Because I am acquiring more than 50%. Remember, we started by saying that what, when the interest I have is beyond 50%, then is a controlling interest. So any other interest above 50% can either be a significant influence or a simple interest. So that's why we call them, below 50%. So that's why we call them a non-controlling interest. Why? Because they don't have control. Now, the question now is that who owns the group? In the case of 100%, who owns the group?
Kemisola.
Kemisola, correct. In the case of 60%, who owns the group?
Partly owned by Kemisola and other non-controlling interests.
So, in the case of 60%, Kemisola and the NCI together owns the group. Why? Because Kemisola has 60% and NCI has what? 40%. So, as the way Kemisola bought shares is the same way NCI bought shares. But it's just that NCI has below 50%. And Kemisola has more than 50%. So the group as a whole belongs to the parent and subsidiary, normal. The group as a whole belongs to the parent and subsidiary. So all asset and liability of the group are all for the parent and the subsidiary. But when it comes to the shares, when it comes to the equity of the group, the capital of the group, the equity of the group as a whole belongs to the parent company and the non-controlling what? Interest. So the same thing with the case of 75%. So in the case of 75% now, NCI will be how many percent?
25%.
25%. Then in the case of 80%, NCI will be what?
20%.
20%. So that's the concept of NCI. So a non-controlling interest. So a non-controlling interest arises as a result of what? Having below 50%, which we talked about earlier on. That
so you said asset and liability are owned by companies and subsidiaries.
By the parent company and the subsidiary.
Only.
Yes, assets and liability of the group are owned by the parent company and subsidiary. Then the only thing the NCI has in the group or in the subsidiary is their own interest that they have. Remember that this 40%, which out of these three categories we stated, which category does it belong? 40%. 40%. Simple interest or 40%. Is it simple interest or significant influence or joint venture?
Associates.
Yes,
significant influence.
That's significant influence. So they are an associate. They are not. They don't have control. They only have significant influence. So, but what we are trying to say in a nutshell is that what NCIs have only the interest in the company. Interest in the sense that what they have their own equity, that's their shares in the company, and they have their own portion. Because they have 40% in the company, then there is a way we calculate their own portion. So if you look at step number 4, so step number 4 says what? Measure the non-controlling interest, right?
Yes.
So now, according to business combination, non-controlling interest can be measured using 2 methods. Non-controlling interest can be measured using 2 methods. Method 1 is what? Proportionate share of identifiable net assets. NCI can be measured using two methods. Method one is proportionate share of identifiable net assets. Then so I want to erase this. So method one, proportionate share of identifiable net assets. Now method two is what? Fair value, otherwise known as full goodwill method. So these are the two methods that we use in measuring NCI. So anytime we are asked, or whenever we see a question and we know that there is a non-controlling interest in the question, then what we now start looking out for is that what? How are we going to measure the non-controlling interest? The question must state it, how to measure non-controlling interest. So if you are to measure non-controlling interest using proportional share of identifiable net assets, the question will say it. If we are to measure non-controlling interest using fair value method or full goodwill method, the question will what? Say it. Now, so let me come to this side. So how do I calculate for NCI? Non-controlling interest. So how do we calculate for NCI? Let me put my mirror sign here. So NCI can be calculated for by saying NCI at DOA. What's DOA? DOA means what?
Date of acquisition.
Acquisition. Then, so that's NCI at DOA. So when we get the value of NCI as DOA, then we say NCI share of post acquisition. NCI share of post acquisition. Then if we sum it up, it will give us NCI at DOC. That's at date of consolidation. So this NCI at DOC, date of consolidation. So these are to calculate for NCI. So anytime we are calculating for NCI, this is how to measure NCI. Yeah, in the group structure. So we say NCI as DOA, then plus NCI share of post acquisition will give us NCI at date of what? Consolidation. So the next step, number 6 step, is what? Determine the goodwill or the gain on bargain purchase. On the
So this one that you just did now is true what? Which of the method?
No. Generally, these are to ascertain or to measure NCI. So when you are calculating this NCI as DOA, the question would have, when we are solving a question, we are going to see the question would have told us how to measure NCI. So in the process of measurement of NCI, it can either be using proportionate share of identifiable net assets or using full goodwill method. So any of the two methods can be used to derive NCI at what? DOA. Do you get?
Okay, I get.
Then NCI share of post acquisition, that one will be done after determining the net asset at the beginning and at the end. So what we have left after acquisition is the portion we now give to NCI. Now, the next one, goodwill. So let me note it here. Methods of measuring NCI. So now, step 6. Step 6 now says determine the goodwill or gain on bargain purchase. Determine the goodwill or gain on bargain purchase. So when we acquire a company, remember that we are acquiring both the assets and the liabilities of the company. So at the acquisition date, we are going to compare the net assets of the company. We are going to compare the net asset of the company with the consideration. Now, what's the consideration? The consideration is the amount that we pay. The amount that we pay to acquire the company. So when I want to acquire the company, let's say I paid 20 million. So my 20 million is the consideration. So the consideration I transfer in the beginning when I am acquiring the company, then the difference between the consideration I transfer and the net assets of the company as at that date of acquisition will give me either goodwill or gain on bargain purchase. Now, goodwill here means it is positive. That means if the difference between the consideration transferred and the net assets as at date of acquisition, if the difference is positive, that is a goodwill. Are you with me? The difference is positive, that's a goodwill. Then if the difference is negative, that's gain on bargain purchase. So this is positive, and this is what's negative. So let me recap on the concept of this goodwill and gain on bargain purchase again. So I said, remember, when you are acquiring a company, you note that you are acquiring both the assets and the liabilities of that company, right? So now, in the process of acquiring the assets and the liabilities of that company, remember that when you are acquiring the company, you are going to pay a sum of money, yes or no? Now, that sum of money that you pay is called the consideration you have transferred. So you have paid that money to the company to buy their own what? Shares, to buy their shares. So that money you pay as at the time you are buying their share is the consideration. Then after you have bought their share, you need to carry out an assessment on the net asset of the company. So we are now saying that what the difference between that consideration that you have transferred, which is the money you have paid at the beginning, and the net asset is the goodwill. It shows that what when I'm buying the company, I'm buying the goodwill together with the company. You know, generally in financial accounting, goodwill is usually bought. There's something we call a purchase goodwill. Goodwill is bought together with the company. So what we are trying to do here is what we want to see the kind of goodwill that company has. So that's why we are carrying out that check. So we are now saying that what the consideration that we have transferred at the beginning minus the net asset of the company as at that date of acquisition, the difference gives us what? Goodwill. So let me now do that computation here. Okay, look at it. Determination of what? Goodwill or gain on bargain purchase.
So how do we get that done? And my never sound here. So look at it. The first thing is what? Consideration received. So the consideration I received is the amount that was paid. Abi?
Yes.
Now, remember that how many people are buying the company together? The parent company and the NCI.
NCI.
They are the two people buying the subsidiary together. So we have to factor in NCI as well. So after consideration received, I'll now come here and say NCI at DOA. So let me come back here. So this NCI at DOA you are seeing here now that we use to calculate NCI. This is where we are going to derive the figure from. Do you get now? That's where we are going to derive the figure from. So NCI at DOA gives us this. Then the addition of the consideration received plus NCI at DOA will give us purchase consideration. Purchase consideration. Then I'll now less. So less what? Net assets of who? The subsidiary. So when you less the net assets of the subsidiary, that will give you goodwill or gain on bargain purchase. So if it's a goodwill, it will be what? Positive. If it's a gain or bargain purchase, it will be what? Negative. So there is a way we treat goodwill and gain on bargain purchase. So let me come here. Treatment of goodwill or gain on bargain purchase. Now, for goodwill, remember I said goodwill. How do you know it is a goodwill? You know it is a goodwill when after you have done your calculation here, what you have is positive. Maya, are you following?
Yes.
You know it's a goodwill when after this your calculation here, what you have is positive. So if what you have here, this section where you have goodwill or gain or bargain, if it is positive, then it's a goodwill. So when it is a goodwill, it means an intangible asset. So goodwill is an intangible asset. So how do you treat goodwill? You add goodwill to add to consolidated PPE in your statement of financial position. So add goodwill to consolidated PPE. No, sorry, to consolidated statement of financial position. You get?
Yeah.
Add goodwill to consolidated statement of financial position. That's treatment of goodwill. So first of all, how do you know is a goodwill? You know is a goodwill when the result you have here is what? Positive. So if it is positive, it's a goodwill. So goodwill means an intangible asset. So as an intangible asset, you add it as part of your what? Consolidated statement of financial what? Position. Now, the next one, gain on bargain purchase. Now, gain on bargain purchase simply means negative goodwill. Negative goodwill. So it means that goodwill can either be positive or goodwill can be what? Negative. So if goodwill is positive,
Positive goodwill means intangible assets, like I have said. Positive goodwill means intangible assets. Now, if goodwill is negative, so negative goodwill means a gain on bargain purchase. Now, how do you treat gain on bargain purchase? There are two ways to treat a gain on bargain purchase. Now, number one, there are two ways to treat a gain on bargain purchase. Number one, if NCI is measured using proportionate method, then number two, if NCI is measured using fair value method. So let's come back here. Remember, when we're talking about measurement of non-controlling interest, we said we have two methods of measuring non-controlling interest, right? The first one is proportionate share of identifiable net assets, and the second one is the fair value or the full goodwill method. So now, here is it. If I have a gain on bargain purchase, which is a negative goodwill, how do I treat a negative goodwill? So the way I treat a negative goodwill is depending on how NCI is measured. So if in the question tells me that NCI is measured at or using proportionate share of identifiable net assets, then how will I treat my bargain purchase? I'm going to what? Add to consolidated retained earnings. Please, all these principles are what we are going to be applying when we are solving questions. Earpiece. Are you sure it's not earpiece? Can you hear me now? Yeah? Still echoing.
Yes, still echoing.
What about now?
A bit clear, but still echoing.
Still echoing. Sorry, FPC come by. Okay, let me see. I will talk about one by now. Can you hear me now?
Yeah, a bit.
I think it's network because I've removed all the earpiece.
Okay, it's clear now. It's clear now. It's clear now.
It's clear now, Abby.
Yeah, it's clear now.
Okay. Let me.
Hey, so you were saying something. You were trying to say something.
Okay, let me connect back my earpiece. So I was saying that when you are calculating for gain on bargain purchase, is it clear now?
Yes, very, very clear.
Okay. When you're calculating for gain on bargain purchase, you have to ask yourself, which method am I using to measure NCI? So if the method I'm using to measure NCI is proportionate share of identifiable net assets, then what will I do to my gain on bargain purchase? I will do what? Add it to consolidated retained earnings. Now, if the method I'm using to measure my NCI is at fair value, can you hear?
Yes.
Okay. If the method I'm using to measure my NCI is at fair value, then how do I treat my gain on bargain purchase? Now, I would apportion the gain on bargain purchase between the parent company and who? NCI. So using their what? Percentage. So remember that if NCI, if parent company has 70% interest, how many percent will be NCI? 30%. So if NCI is measured at fair value method, so the treatment of gain on bargain purchase is going to be what? Apportion that gain on bargain purchase between the parent company and the NCI. So the amount that belongs to parent company, then you now say add to consolidated retained earnings.
That's after apportioning, Abi.
Yes, after apportioning. So add to consolidated retained earnings for parent company, then add to non-controlling
Interest.
for who? NCI. So that's that. So we have been able to talk about the steps of acquisition method according to business combination. So according to business combination, we said the controlling entity is expected to account for the business combination using acquisition method. So we said according to acquisition method, you identify the acquirer, identify the acquiree, identify the date of acquisition, identify the net and the asset and liabilities at date of acquisition, identify the or measure the non-controlling interest. And we said non-controlling interest can be measured using either what? Proportionate share of identifiable net assets and what? Fair value of full goodwill method. Then determine the goodwill or gain on bargain purchase. And we say we can determine goodwill or gain on bargain purchase using the formula or the format below. So that is the step, or those are the steps to in acquisition method. So now let's do something. The material I sent, the PDF I sent, the first thing we are going to do now is let's learn how to calculate goodwill and how to measure NCI.
So let me scroll down to that treatment. I want to copy and finish from there. That game.
So where?
Treatment.
Yeah.
Yes. Thank you. Just give me 2 minutes, please.
Are you done?
Yeah.
Okay.
So take a screenshot.
So very quick. Now let's open that PDF I sent to the group. So now let's learn. First thing, let's learn how to calculate or how to determine goodwill and how to determine or how to measure NCI. Have you downloaded the question?
On the group, have you?
Yeah, it's on the group.
I'm coming. I'm just using one device because.
Oh, okay.
My
So this is
my PC is down.
Okay.
Okay.
Goodwill.
Okay, I've opened it.
Okay. So let me merge this. So let me call it determination.
Which of the question?
We start with the first one of goodwill
Okay.
and measurements of NCI. So let's start from there. So let's start with question 1. Prince PLC. So are you there?
Yes. But I might just want to go to this screen because if I'm on the question, I will not see the screen.
Oh, how will I? And there's no way I can. Let me see if. Okay, wait. Just give me a few minutes, please.
Okay.
Come in, let me. So, the problem now is how I want to merge these things together. Can you see two things there? Or is it still only the Excel sheet? Is it only the Excel sheet you are seeing?
Usually Excel sheet I'm seeing.
That's the issue now. How I want to merge this. Let me see.
That depends if your laptop can do split screen. Can laptop do split screen?
Let me see if my laptop can split the screen.
So if you can do it, it should be from that edge, the right edge. That should try.
Right
The right
edge.
edge of that Excel. Yes, to your right, yes. So it should, yeah.
Yeah.
You should be able to do it, yeah. Yeah, you're supposed to change from that arrow. Something like that. You're supposed to change from that arrow for it to be able to like adjust.
Huh? I don't know if this thing can do.
But okay, you're thinking I might not be able to follow if you are just reading from question. Oh, so because I'm thinking we just do the solution. I might just grab.
I should just do the solution of it. Let me see first if I can see. I'm not even seeing. Let me see the settings.
Meanwhile, your piece is echoing again.
I didn't even know what's wrong. I think it's network.
Okay.
That stop echoing now.
Yes.
Network. Which one is using? Put it low. Okay, you know what I would do? Let me just. So this is the question. Let's read the question. Then when we read the question together and establish the facts from the question, we'll now go to the solution like that. Is that fine?
Okay. Yes. I think that's okay.
Are you seeing the question?
Yeah,
Are you seeing
I can
seeing
see
the
it.
question?
Yes.
Okay, so it said Prince PLC acquires 80% of the equity shares. So 80% of the equity shares. That means, is this a controlling interest or a non-controlling interest?
Controlling interest. The
Controlling
parent
interest.
company.
A parent company, right? Exactly. Now, Prince PLC acquires 80% of the equity shares of Princess PLC. So now, who is Prince PLC? Who is Princess PLC?
Prince PLC is the parent. Princess PLC is the subsidiary.
Princess is the subsidiary. So means Prince PLC is the acquirer. Princess PLC is the acquiree. Then on 1st of January 20x7. So what is 1st of January 20x7? Date of what?
Acquisition.
Don't forget the steps. Identify the acquirer, identify the acquiree, identify the date of acquisition. Then they now said for 500 million. Now we are buying Princess PLC for how much? 500 million.
Yeah.
So this 500 million represents the what? Consideration. Remember we talked about consideration when we were checking out to determine goodwill, right?
Yes.
The consideration that we received is the 500 million. So that's the consideration. Do you get now?
Yes.
When the fair value of the identifiable net asset. So if you look at this question now, this question has restricted us. They've given us the fair value of the identifiable net asset of Princess PLC as at 1st of January. How much is that? 560 million. Now, it is the policy of the group to measure NCI on acquisition based on what? Based on their share of identifiable net assets. So look at it. It is the policy of the group to measure NCI on acquisition based on their proportionate share of identifiable net asset. So what does it mean? It means that what we are measuring NCI based on proportionate method. Don't forget, how many methods of NCI did we establish? Two. You said it's either NCI is measured at proportionate method or NCI is measured using what? Fair method. So in this question now, they are telling us that NCI is measured using proportionate method. So required, construct the group structure, then B, calculate goodwill on acquisition, and state its required accounting treatment in accordance with IFRS 3 and IFRS 10. So let me bring it back to the solution sheet. So can you see the solution sheet now?
Yes.
Okay. So let's go. Okay. So illustration 1. Mi ò máa ṣe. So the name of the group is what? Prince PLC.
That's the parent company.
Yeah, Prince PLC. So, like, that's the name of the company generally. The group. That's the group itself, Prince PLC. So, A, what's the requirement? A,
Prepare structure. Group structure.
group structure. Now, group structure. Let me move this to this place. Now, group structure is what? So, Prince PLC acquiring who? So, this is how we draw the group structure. So, are you with me now?
Yes,
So, Prince PLC acquiring Princess PLC. So, you now come behind and beside it. How many percent is Prince PLC acquiring?
80.
80%. Then you now put the date of acquisition beside. That's at what? 1st of what? January 2027.
X7.
So that's your group structure. So I now like to do something. So what do I like to do? What I like to do is that because the parent company is just acquiring a part of the total shares of the subsidiary, right? So it means that there is a non-controlling interest. Yes or no?
Yes.
So now underneath, I'll say non-controlling interests. So my non-controlling interest will be how many percent?
20%.
20%. So we are done with our group structure.
Okay.
That's the structure. That's the group structure. So second requirement now is determination of what? Goodwill. Abi now. Determination of goodwill. The asked to determine goodwill. 20. So let me show you. 20%. No, come on, I don't know what kind of system. It's I used to have 20%. What's wrong with this thing? Okay. Not being okay. Now, number 2. Number 2 is what? Determination of what? Goodwill. Abi?
Yes.
So we want to determine goodwill now. So how do we determine goodwill? Let me come here and put
They already told us the method to use, right?
Yes, they told us good determination of goodwill does not have a method. It's measurement of NCI that has a method.
Oh,
In the
okay.
question, they've already told us that NCI is to be measured using what?
Fair value.
Proportionate share of identifiable net assets. That's proportionate method.
Okay.
So let's come back here. So what's the first thing in the determination of goodwill? First thing is your consideration received, right?
Yeah.
Come here. My consideration received. So how much is the consideration received?
5 million.
500
500 million.
500 million. 500 million. Now, after consideration received, the next thing is what? NCI at what?
Date of
DOA.
acquisition.
So I'll now come here. NCI at DOA. Now, how do I get NCI at DOA? Now,
You use two methods.
NCI at DOA. Now, we have been told in the question that what we should use is what?
Proportion.
Proportionate share of identifiable net assets, right?
Yes.
So, in using proportionate share of identifiable net assets, how do I get NCI at DOA? I'll now come here. What is NCI's percentage?
20.
20%, Abi. So NCI percentage is 20%. Then what is the net asset of the subsidiary as a date of acquisition? 560. Abi? The net asset of subsidiary as a date of acquisition is 560
million.
million. So I'll come here. 560 million. Then if I come to this place, let me see whether so let me see. So it's not giving me the
You
value.
have to change that cell to percent. No, the one at the 20%.
I change the percent.
I'll take it from
Think
percent. Just do it 0.2. Do 0.2.
0.2.
No, you have to remove the percentage for it to trigger. Don't make it 0.2.
0.2.
Yeah.
It's still giving me.
Put that 0.2 then. So you have to format that cell out. Format that cell out from percentage.
Not in percentage, is in accounting.
Okay, so then put only 0.2.
I formatted everything to be in accounting.
But percentage is still showing there.
That's what I'm saying. It's okay, 0.2. Okay. So let me come here and see.
Yes, your formula work like that.
Still not.
Something is wrong with your exam. No, wait, do. Click that 500 million. Click that 500 million.
Okay.
Yes. So click on that format painter that is up. No, format painter. That is on your left side. Left. Go to the left. No, take that arrow to the left. Yes.
Okay. Yes.
So use it to paint that 0.2. Use it to paint that 0. No, that's 0.2. Okay, so yeah, do that formula again.
Cost this.
When you click that value, there's an icon. So you click that icon, it's supposed to give you something to convert to. No, the way you did it before. Yes.
This one.
Yes. So that icon, yes. Click that icon.
It's
That
saying
one.
error in value. Which one?
No, that yellow one that is near that value. Yes.
Yeah, that's what I clicked. This is what it's bringing. Ignore error, show calculation step, help on this error checking option.
Wow. It's not supposed to be like that. Something is showing.
Wait, let me see first. Let me use formulas here. Which of the formulas will give multiplication?
How about you change it to number? The format. I think there's number. I think there's number.
Okay. Let me see. Number. Okay, let me see first. 20%, right?
No, let's just do 0.2.
0.2 then.
Okay.
560 million. Let me see. Let me tell me calculator a lot on me.
Okay. I don't even have my calculator. Sorry. Okay, I'm back. So 0.2 times 500 million.
It's not 500, 560.
Oh, sorry. So that's 1,120,000.
1,120,000.
Yes.
So with the sum it's together. Just want to the magic. Don't shake me now.
I'm coming now. Let me do it. 6,720,000.
So that will give us what? No, it's 500 million plus 1,120,000.
Oh, sorry. 5.
So now that should give us 501 million. Are you sure 20% of 560,000 is 1,120,000?
No, so 560
times 20% is what?
it is 11,200,000. Wait, sorry. 112 million. Yes, 112 million. Yes. Sorry. Yeah.
So if you now add together, that gives us 612 million.
Yes.
This 612 million is our what?
Purchase consideration.
Consideration. Purchase consideration. Let me bold in it. Then the next thing will now be what? Less
net asset of subsidiary.
Yeah, you can call it net asset or fair value of subsidiary at what? DOA.
So what's the fair value of subsidiary given to us? It's 560.
560 million.
560. Put it. 560 million. So what would that give us?
$52 million. 52 million.
52 million.
Yes.
52 million. So this 52 million now, is it positive or negative?
Positive.
So we now call this a what?
Goodwill.
Positive, exactly. Positive goodwill, or you call it intangible assets.
Okay.
So the treatment of this goodwill now, when we are now learning how to consolidate, that's when we are now going to start taking the treatment how it's supposed to be. So do you get now?
Yes.
So that's how to that determination of goodwill. So this for question 1. Are you writing it?
I have screenshot, don't worry. So let me not delay our time. So I'll just write it out.
Okay, so let's quickly look at the next question. Let's just look at one more question there. This B. Okay, so let me do number 2 here. So let's go back to the question. Let's go back to number 2 question. So number 2 question. So if you look at number 2 question, okay, wait, let's look at number 3. Now look at number 3. Prince
Okay.
PLC acquired 75% of the ordinary shares of Grace PLC for $480 million on 1st of January 20X9. So don't forget the principle. The first thing is what? Identify the acquirer.
Acquirer.
So Prince
PLC
PLC
is the acquirer. Identify
Grace
the
PLC
acquiree.
acquiree.
Yes.
Then identify the what? Date of
acquisition. 1st of
What's the
January
date of
20X9.
1st of January? Exactly. Then how much? What's the controlling interest of Prince PLC in the
75%.
5%? So definitely there's a non-controlling interest of what?
25%.
Now, you said the fair value of the identifiable net asset of Grace PLC on 1st of January. Remember, we said that what in the steps, you always determine the net asset or the fair value of the asset and liability of the subsidiary.
On the
Right?
date of acquisition.
Exactly. So that's the fair value given to us, which is 540 million. Then I said it is the policy of Prince PLC to measure NCI using what? Full goodwill method. So you can see now, this one, NCI is measured using full goodwill
method. That's it.
Sorry.
For this purpose, the fair value of NCI in Grace PLC was estimated at 140 million. So here is it. Anytime the question tells you that you have to measure NCI using fair value, okay, two things. Is either the question gives you the fair value of the NCI, or the question gives you information on how we are going to calculate the fair value of the NCI. So look at this question very well. It said, for this purpose, the fair value of the NCI in Grace PLC. The question did not say the fair value of Grace PLC. So if the question had said the fair value of Grace PLC is different, what are we looking for? Fair value of NCI. We are not looking for fair value of Grace PLC because we have to measure NCI using what? Fair value. So the fair value of NCI in Grace PLC is 140.
Given.
Is given to us. So let's quickly solve that. So the group structure and then calculate the goodwill. Okay, so now let's go. The name of the company is still Prince PLC. So group structure. Group structure. So
Change that one to Grace.
yeah, I would. So this one is Grace PLC. Then so we have the interest to be what?
75.
5%, and the date of acquisition is what? First of what?
January 20x9.
20x9. Don't forget. Now
NCI.
controlling interest to be how many percent?
25.
25%. So total, that's a group structure. Is A. So B now. Determination of what? Goodwill. So let's determine. Let's determine goodwill. So the first thing is always the what?
Consideration received.
Received.
480 million.
So the consideration received, that's the amount that was paid on the date of acquisition, is 480
million.
Then we have this place. Okay. Now, so after consideration received, the next thing is always what? NCI at what?
Yes.
Remember, in this question now, we are told that NCI is to be measured using what? Fair value. So
Yes.
NCI is to be measured using fair value. We are giving the fair value of NCI.
So what's the fair value of NCI? 140 million. Abi? So if we had it together, 480 million plus 140 million, that will give us 620 million. Yes.
Sorry, but
620.
when we were doing the previous one, I thought you did the percentage of
Yeah,
the.
this is, so let me indicate it here. This method here is when NCI is at what? Proportionate method. This is proportionate method. So it is
Oh,
when
I
NCI
think.
is using proportionate method.
Sorry, take me to that slide where you differentiated between that method. I think I didn't take the screenshot. I didn't notice. No,
I said proportionate method and fair value method. I didn't give a breakdown of the two methods. That's why when we are solving question, I'm explaining those two concepts. So if it is proportionate method that the question says we should use, then
yes.
proportionate method means that you will multiply the percentage of NCI by the fair value of the subsidiary, which is what we did.
Okay.
That's for
Okay.
proportionate method. But if it is fair value method
Wait, you say by the fair value of the
of the
subsidiary?
subsidiary, yes.
Okay. Okay.
Then if it is fair value method, then like I said, two ways. Is either the question gives you the fair value of the
Or tells you how
NCI
you calculate it.
subsidiary, or gives you on the long run, you will see how we can determine fair value if fair value is not given to us. So
Okay.
this is our purchase consideration.
Okay.
The purchase consideration. Remember bolding this. Then what's the next thing we are going to do? Less what? Less
Fair
fair value
value of subsidiary.
subsidiary. So what's fair value of subsidiary in the question now?
540.
540 million. So we are to less.
80 million.
Less. So what would that give us?
80.
80. So 80 million. So 80 million is positive, Abi?
Yes, goodwill.
Because it is positive, so that will be positive goodwill or intangible what? Assets. So this is how to determine goodwill. This is how to calculate for goodwill. So because in the question, when we start learning how to consolidate, we would always need calculation of goodwill as part of our workings. So that's why it's always important to start by learning how to calculate for goodwill. So next week we'll look at another way. There's a particular question where we are given another way which we are going to use in determining the fair value of NCI. So next week we'll look at that kind of question like that. We'll now move to IFRS 10, which is consolidated financial statement. And from there, we'll now start learning how to consolidate.
Okay.
From the timetable I drew, I only allotted group account to Tuesdays alone. Why Friday we are supposed to use Friday to do standard, any other standards. So that Tuesday is just group account alone because of the complexity, or let me not say complexity, how voluminous group accounts is. It requires a lot of adjusting entries that so every Tuesday is group accounts, then Monday is financial management, Wednesday
Why?
is
Sorry. Why are you going to now put like group accounts in maybe like Friday instead, or putting it? Because it's during the week. I don't know. I feel like I don't know other schedule, but that people turning up. So because during the week might be a busy schedule that people might not really turn up for it. Like
Say who is apart from you and the other person that is coming and going, who else is there?
okay, it's
So
true, sir.
I think it's everybody's cup of tea at this junction. You know, me to pyro to soon. I not shout again. It's not me that send them to come and do it. Or I can let or share. Hey,
They
I
are in
forgot
last
I'm,
student now, Abi.
I forgot I'm recording this thing.
Oh.
They will hear.
You know, exam is coming up for in last student, so some people might be busy with
Actually,
school study.
one of them, Simon. Yeah. Apart from only one person, Mark, that was like he said he's finding it difficult to log in. So, but I'll share the recording and the sheets.
Okay.
Now, just hope they understand all this arrow that somebody's drawing. No. Okay, Jerry. So, sorry. We are going to call it a night at this junction. There's lecture tomorrow. All right. So we leave every other thing till next week.
All right. Thank you.
Yeah,
Good night.